All righty, we'll go ahead and get started to keep everybody on schedule today. So, Pete, thank you again for being with us. Always a pleasure to have you. I know this is probably a very timely market update webinar from the conversation Pete and I were having right before this on the debt ceiling stuff. At least in principle, things have been agreed upon. So, but Pete, always appreciative that you take time out of your day. I always love getting the chance to hear you talk about the markets because I'm a nerd, if you will, like that. And you always have all the data that I just constantly just stay tuned to. But anyways, so thanks again for taking time out of your day to do this for our clients. So just quick kind of formality here as we go through. If there's questions, load those into Q&A text chat, and we'll get to those as we go. And we'll save some time at the end as well. But Pete, tell us kind of where markets are. What's been driving the markets so far year to date?
Yeah, sure, Mark. Thank you. And thank you for inviting me back. Glad to talk to you and your folks. I'm going to share my screen here just to kind of bring up a few pictures in the background. Is kind of, you're asking, Mark, kind of what's happened so far this year? What have been the drivers? We really look at five main areas of what does influence the capital market. So for us, this is in essence kind of that 30,000 foot level. We look at the economy, monetary policy, what valuations look like, what investor sentiment is, so kind of a shorter term gauge, and then what's going on with interest rates. We really adjust these as we start every quarter. So as we ended Q4 last year and moved into Q1, we had these gauges in a particular spot. You can see going from Q1 to Q2, we only made one adjustment, and that's to monetary policy, kind of continuing to acknowledge that we are getting near the end of this rate tightening cycle. I do think that's a net positive development for the market. The economy, we kind of have in that neutral position. We're growing. The first quarter grew, but we do expect slower growth as we move through the balance of the year. And the economy has really been resilient. The job market in particular has really been resilient as we've seen kind of data so far through the first 4 or 5 months of this year. We do kind of the way we've been talking about is we do see clouds developing later in the year from an economic perspective. We think it's probably that 45-50% chance that we get a soft landing. So the economy continues to grow. We don't have a recession, but we do think it's probably that 45 to 50 that we do get a recession, but we think that would really be a mild recession. And I'll tell you why we think that here in just a couple minutes. And then there is, again, low probability in our opinion, but kind of that 0 to 10% chance that it is I would say a more normal recession, meaning a kind of a worse recession than what we expect. Again, that's kind of really a small probability event in our opinion. Mentioned monetary policy has been improving. I'm going to go through some slides to talk about every one of these gauges. I'll talk about these gauges really quickly right here off the bat, but trust me, I'll show you a few pictures. Valuations, I'll show you a couple good slides on that, where earnings came down in 2022 from 2021. But it was really interesting to see the way the stock market reacted. While earnings were declining, earnings declined somewhere in the neighborhood of 5 or 6%. But if we think about it, the worst kind of from peak to trough, the S&P was down, I think it was over 24%. And for the year, the S&P 500 was down over 18%. So that's in the context of earnings dropping 5 or 6%. So it really looked like stocks were pricing in a much worse earnings environment than we actually saw. We have valuations in neutral because one of the things last year did, since the prices came down and earnings came down a little bit, but not to the same degree, really created a better kind of an earnings environment, a good valuation, a better valuation environment, the way we measure that price to earnings ratio. So I'll talk a little bit about that, show you why we're kind of in that neutral territory. Investor sentiment, this is a positive gauge in our opinion. This is a contrarian indicator, and I've got a really good slide to show you what I mean here and why we talk about this. But it does lean a little bit positive because we are still seeing a little bit more bearishness and a little bit more pessimism developing in the market. And then interest rates, we have this as a slight negative. Clearly, interest rates went up last year. That was one of the big stories of 2022. They've started, especially a little bit further out on the yield curve, kind of longer dated interest rates. Those have started to come down. And I think importantly, we are really near the end of this rate hike cycle, in our opinion. So a lot of things happening, but it was interesting when we came into the second quarter, seeing very similar conditions as we saw as we entered 2023.
So quick summary, Pete, like I always try to do, where we've been on the economy, earnings have been coming down, which is why that's kind of in the neutral part of the picture. The gauge is set to neutral, excuse me. We've got monetary policy, which has improved, but it's been in a very, rate hike, Fed tightening policy for the last 18 months, really. Valuations are better. I mean, I remember when you guys had this gauge at like slow or half reverse. And, I mean, valuations were just really, really lofty. But because of last year, values have come down relative to what earnings did. And so that was part of what drove markets last year. Investor sentiment, again, has been negative, which is why you'll have this gauge set to slow forward. And then on interest rates, again, the slow reverse, if you will, because they're still elevated, but we might see an improving landscape, at least out into the future, because of the longer dated bonds, et cetera, interest rates that you were talking about a second ago. Yeah.
Yeah. Really good summary there, Mark. Yeah. And I will get into details, and I think this will help as I kind of show a few pictures. And again, happy to have you jump in as well as we're talking about these. So I'll kind of follow in order the way we're looking at these gauges with the slides I have. Again, I've got like 14 or 15 slides, but please feel free, Mark, to jump in as well as we're looking at those. But when we think of the economy, the one thing I think is so important to point out has been the strength in the job market, right? That at the end of the day, consumption, so you and I out spending money, is roughly about 70% of the economy. So we pay particular attention to how are consumers, are they employed? Are they getting real wage gains? Are they confident to spend that money? That is a really important driver of our economy here in the US. So what this slide shows is, there are millions more job openings. You can see this is above 10 million job openings. I can tell you that's come down a little bit. So we are starting to see the job openings come down somewhat. I think it's in that kind of 9.5 million range now based on the latest month. But jobless claims are still low. Those are people filing for unemployment benefits for the first time. The unemployment rate ticked down to 3.4% in the latest monthly reading. That matches the lowest level since we've seen, believe it or not, since 1969. So really has been a strong job market. One of the clear reasons why we think that if we did get into that scenario where we get a recession, it's hard for us to envision a really deep recession with such a strong job market. It's kind of one of those anecdotal things. When I go to my local coffee shop or go get something, boy, there are a lot more help wanted signs in businesses than we're going out of business, right? Not something you tend to see in a recession. Is businesses really still trying to hire people? There's still millions of more jobs open right now than people seeking jobs. So really tight labor market right now, but really strong from that job seeker position or stance. Inflation, again, the bogey that the Fed was really looking at last year, the reason why they were so aggressive with the rate hikes was the elevated inflation we were seeing. And we see it, right? The producer price index got north of 10%. The consumer price index, got up to about a little over 9%. I mean, these were elevated inflation readings. Remember, the Fed was using the word transitory for quite a few months in a row. Turned out that they really needed to be aggressive with their policy to try to bring this down. But this chart clearly shows we're seeing inflation trending lower, right? We have seen this movement in the right direction for inflation to improve. We think that will continue. You can kind of look at this and say, well, okay, clearly inflation is still above that Fed goal, remember that's that 2%, approximately 2% inflation on a core reading of that red line. So that's the personal consumption expenditure index, but they're looking at a core version of they take out the food and energy, but we're still above that long-term goal for the Fed, but directionally we're heading in that area. So the Fed could look at this and maybe pause in June and say, hey, we're making progress, inflation is moving in the right direction. Or if they wanted to take it and say, boy, inflation is still elevated, we want to raise rates again. This kind of can justify either way that they go there. And I can tell you, we'll get into a monetary policy. The odds have picked up of another quarter point rate hike at the June meeting. This just shows a couple of input prices. So we think of what those core prices are. So DRAM chip prices, right? Shipping index and what it costs to ship things from one area to another, fertilizer costs, kind of really basic input costs. You can clearly see these have been moving lower, right? Shows that this process of lower prices is starting in these kind of core areas, these input costs, and we think these will continue as we move forward. One of my favorite slides, if we think of valuations in the stock market, kind of a fundamental step back here for a second. We do think in the long run, what drives stock prices is what a company earns, right? Not a totally foreign concept there, right? What a company earns should drive what we're paying for that company's stock. And if you look at this slide, that's really what it shows, is that over the long run, we can see the price, the S&P 500, that's the blue line, really is kind of moving in relationship to what earnings are. When earnings are growing, we see those stock prices going up, and that's the gold line. So again, not a mathematician here, but those lines look like there is some correlation there, right? Where earnings do drive stock prices over the long run. Let's look at the last kind of part of this grid, this slide here. What did we
real
go
quick.
last? Yeah, go ahead, Mark.
Sorry, I'm going to correct you on something. You said you're not a mathematician. Yes, you are. You have your CFA.
I appreciate that. Not a math. Got pretty good credential there, but yeah, no. Yeah, it is. When we look at this, and this really stood out to us last year. In all seriousness, this one really kind of hit us. If you look at the blue line, we had a pretty big drop in stock prices, right? I don't need to tell you that, right? Mark knows that. I know that. You know that. I mean, we know it's a really challenging year in the stock market when we look at what happened to stocks. Look at the gold line. So yes, earnings did decline. As I mentioned, they dropped about 5 or 6%, but stock prices really reacted as if we were going to have a much more challenging earnings environment than we actually did have. And it feels like the last couple of quarters has been the stock market kind of recalibrating, if you will, of, hey, earnings didn't drop as much as might have been expected. And kind of the good news is we've actually started to see some stabilization in these earnings revisions that had been going lower. So we were fully anticipating that earnings estimates, they usually start out a little bit high, and then as you're kind of getting closer and further in time and kind of closer to when the earnings get released, you start to see those sometimes come down. So if we look at that first gold column there, those were the estimates for 2023, and we were kind of seeing these come down. Wasn't unexpected. We thought that would happen, but kind of the good news, and this has happened over the last few weeks, or let's say maybe the last month or so, is it does seem like those earnings revisions have started to stabilize. And we've actually seen a little bit of improvement in some of the earnings, from some companies after this most recent quarterly earnings cycle. So it does feel like we've kind of changed a little bit of the direction there. And my gosh, we're sitting here, it's the last day of May. We're going to pretty soon start talking about 2024 earnings, right? Remember, the market is looking forward. So that's going to become more and more into the focus. So it was a year, 2022, you can see earnings decline from 2021, but not as impactful as really it felt like the stock market was pricing into. So one of our thoughts is, if we did get kind of that mild recession, which is in that 45-50% probability in our opinion, we feel a lot of that might have really been priced into the market already last year. So those are things that we're looking at and we continue to analyze. But again, really, we've seen, looks like some stabilization on the earnings. And like I said, we're pretty soon going to start talking about next year's earnings, which would be 2024. So rates. So this is the Fed. So we were talking about how we kind of picked this up in improving direction, but still negative when we think of where Fed policy is. We're still in a rate tightening cycle, but we do believe we are in the very late innings. And, again, a lot of debate on what will happen at the June meeting. Will they raise or won't they raise? We could kind of fill in one. We know they raised in May, so they did raise another quarter point. There are these Fed futures where they're kind of estimating when there might be potential cuts. Now, we've been saying all along, we think those are probably a little bit aggressive. We're not expecting necessarily rate cuts this year, but if we can get to a point where the Fed is on pause and they are kind of in their normal, hey, we're analyzing incoming economic data, we think that would be a good backdrop for the market. And again, so whether we get one or maybe even two more rate hikes, remember, we've raised rates 5.25% already. That's what the Fed has done since March of 2022 through May, through this month. So whether we get another quarter or a 0.5%, we've gone through the bulk of this rate hike cycle. We really think we've turned the corner. And that's why we've kept notching up that monetary policy gauge, still in negative territory, but it has been improving, in recent months. That investor sentiment gauge, so it was a positive, remember, it was a slight positive, and I mentioned to you how this is a contrarian indicator. So why is it a slight positive? Well, if you look at those top four, kind of those grids for March, you can see where, bearishness is about 42, 48, 49, 45 in that percentage. If you look at the historical averages, we on average have about 31% of people falling into this bearish category based on this poll. So being in those mid 40s is above those longer term averages. So again, a little bit more bearish. So in our world, being a contrarian indicator, we have that as a slight positive. Now, let me kind of bring that point home to you, which I think is a really good example of this idea on, okay, why are you saying contrarian? You're kind of going two different sides here. Let's look at the bottom line there. So the week ending 9/21/22, look at that bearishness. Almost 61% of people polled were bearish. Now remember, that average is about 31%. So not quite, but almost 2 times the amount of historical bearishness we get. Now, what happened about 3 weeks after the end of that reading? The market bottom. So the market bottom for the S&P 500 was October 12th. So once again, and that's the pattern we tend to see with this kind of information, is that when things get too bearish and too extreme and people are too negative in the market, we often see those as we're kind of getting towards or putting in that kind of shorter term bottom. And the contrary holds too. When things are too positive and too optimistic, that can often signal that we might be at a near term top. So again, I think it does a really good job of showing that idea. Boy, huge bearishness, 1 year high in bearishness right there at the end of September. What happened in early October? Well, the market did bottom, and we've actually had a couple pretty good quarters, good recovery in the market since those October lows. I think one way to kind of a final takeaway idea with this slide is there's a classic Warren Buffett saying, and I'm probably not saying it exactly right, but one of his classic sayings is, be greedy when others are fearful and fearful when others are greedy, right? That's in essence what we're trying to capture with this gauge. So again, kind of an interesting one that we look at. It can be a little bit more short term. It's a very sensitive gauge, but it is something we keep an eye on. We talked about interest rates. And so we do think those longer term rates will be coming down. You can see where rates were at the end of October. And yes, we see those shorter term rates. So the red line is still higher from where we were at the end of October. Now, why is that? Well, a lot of that's because the Fed has continued to raise rates. But really, if we think about it, the market does a better job of controlling those longer term interest rates. So longer term interest rates have come down. We hit 4.25%, 4.25% was the yield on the 10-year Treasury in October. That was really the high it hit during this cycle. And we know today it's about 3.6, 3.7, somewhere in that range when we think of where the 10-year Treasury yield is. So Interest rates have come down, especially further out on the yield curve. That's something we're seeing, and it's something we believe will continue. We've kind of put a target of about 3% is where we think the 10-year treasury yield will get to by the end of this year. Now, it's going to be volatile, and boy, it hasn't been volatile. We've had a lot of volatility in the bond market, but we think directionally we're going to likely trend lower when we think, especially further out with those longer interest rates on the yield curve. We get the question, is the bear market over? So we all wish we knew that, right? Unfortunately, my crystal ball is as good as your crystal ball when we look at this stuff. But this is an interesting technical that we do look at, and again, we're very much fundamental analysts at Clark Capital, but we'll look at kind of market trends as well. This is one that they call the golden cross. So you can see here we have the S&P 500 plotted next to some moving averages. So the 200-day moving average of the market and the 50-day moving average. So a shorter term moving average and a little bit longer term one. And you can see those crossed right as we were going through the beginning part of 2022. So that orange line, that shorter term trend, broke through that longer term 200-day moving average. And what do we see? You can just kind of see it in the S&P 500, that dark blue line. You see this series of kind of lower highs and lower lows, right? The market goes down, it rallies, but not quite up to where it was before, goes down even further, rallies, doesn't quite get to where it was before. We call those kind of lower highs and lower lows. As we kind of started moving into this year, you can see that trend of the dark blue line starting to change. And you can see we did have it in this, they call this technical move, this golden cross, where the 50-day did move above once again that 200-day. So it kind of signifies that trend is now improving when we're looking at where the market's going. You can kind of see visually, okay, now we've got a series of higher highs and higher lows as well. So one of those things, and again, history doesn't need to repeat itself. Technical measures kind of give us some insight into some of the pricing action, but it is something we've taken a long look at. Different conditions that we saw in 2022. How does the market react after a challenging year like we go through in 2020, like we went through in 2022? And this is one we thought this was kind of a good picture just to kind of show the trend does look like it has started to improve. We've had 2 quarters in a row of positive stock returns, Q4 of last year and Q1 of this year. So again, that's usually a pretty good historical sign as well that you might be beyond that bear market that we know lasted, for 3 quarters that we were going through the first 3 quarters of 2022. Just a couple final slides. We've been getting a lot of questions on, why don't I just buy a 2-year treasury or a 1-year treasury? We know those short-term rates are a lot higher than the longer term rates are right now. And that's kind of that inverted yield curve, right? We've talked about that a little bit. So the way we look at this is, we really want to make sure we're looking for the right opportunities. And, frankly, if somebody has a really short-term time horizon, then I think looking at these short-term opportunities can make sense. And again, that's something that Mark can talk to you about, and I'll kind of let him, talk to you about his thoughts there. But the reality that we usually deal with is most clients don't have a 1-year time horizon, right? Most clients have a 2 or a 5-year goal and a 10-year goal and a 15 and a 20, and kind of how do we get and meet those long-term goals and objectives. So we think it kind of takes the eye off the ball a little bit when you see these really kind of these short-term rates that we haven't seen in a long time. But then what do we do after that? Remember, this is where we get into what we call in the investment business reinvestment risk. So I buy something for 1 year, it's got that 1% interest rate that looks so attractive. Then what do I do in that year when that year is done? What if rates have gone down? What if the market's gone up? How do you kind of manage through that? That's a real challenge. So we want to kind of always keep kind of that broader term perspective, look at broad opportunities as we see them out there, and really try to say, are there different places to take advantage of? And I can tell you, as an active bond manager, the team has been looking at some of those higher short-term rates. And they've also been saying, where further out, what higher interest rates further out do we also want to take advantage of? Yes, we know they may not be as high as some of these shorter term rates, but they're higher than we've seen in years. So we want to make sure we don't let those opportunities pass as well. So we really take an active approach on kind of where we want to be positioned, but you really run into kind of a classic risk, which we call reinvestment risk. If you're kind of losing that longer term perspective and, only focus on a really short term, if that is not what your time horizon really is. We threw in one slide, banking. And again, this is kind of gone back and forth with when the market's been more concerned or not. This was more kind of March and April kind of time frame. We know it kind of reared its head again, a little bit after that. The way we've been talking about it is we're going to continue to watch this. We're going to continue to watch. Are there other repercussions that we see from some of these regional bank issues? We're not comfortable making an all clear call. We want to keep an eye to see how does this kind of develop. We know we still got a lot of rate hikes that this economy is going to have to absorb. The way we learn this is it takes about a year for a rate hike to get into an economy. So we really want to see how those aggressive rate hikes that we started to get into summer and fall of last year, how those start to impact the economy. But I will say this, we do think it looks more contained when we look at what's happening with the banking, situation this time. Looks very different than what we were seeing, in 07 and 08, where this seemed to be kind of a mismatch, right? Of assets and liabilities, kind of the depositors had, and then how did those banks invest those? Bit of a mismatch versus kind of bad credit. Bad credit is really what we saw in 07 and 08. So feels different. Again, we want to keep an eye on this. We continue to keep an eye on this, but it does look like it is more contained, and we feel it looks very different than what we were dealing with in 07 and 08. And
Pete,
yeah, go ahead, Mark. And I got one final slide, but go ahead, Mark, please.
Yeah, no, I was just going to do a quick recap, and maybe this is a good slide to end on after a quick recap. So reminder for everybody to load their questions in while I do this. So the economy is looking good as far as unemployment numbers, right? I think that's what we started with. Shipping costs are coming down.
With the job market is looking good. We want to look further out in the year. We see that there could be likely slower economic growth later in the year, but still in the context of a really strong job market. Yeah, that remains kind of the core strength of the economy, Mark. Yep.
Inflation's trending in the right direction.
Yep.
We've seen it come down off the historic highs. Fed likely done or not done. I shouldn't say done. Likely close to being done with their rate hikes. Nobody knows. I don't even think Jay Powell knows, quite frankly. TBD. But maybe, well, they're closer to being done than they are further away from it anyway. So we'll see how that plays out. Valuations, again, you talked about earnings coming down last year in the stock market. I'm not a mathematician. You might be, but the blue line got below the gold line, right? Which generally means that that's probably a decent time to go buy stocks, right? Especially if you're in the market to own something long term. So improving outlook for earnings, right, to go alongside of what you're about to talk about, which is recovering stock prices. And then let me see, sentiment is still very much, more bearish, meaning more people are thinking the sky is falling than historical averages by, well, I don't know, 10 percentage points roughly, I think was what the slide had, 31 versus 45, give or take. So the thing I also noticed was that the number of people who are optimistic seems to be at pretty low points as well.
Right.
So plenty of room for improvement there, which also bodes well for the future outlook on a contrarian basis. And I know I'm missing something, Pete. But anyways, that's kind of my.
It's a good summary, Mark, and it's interesting because I've almost gone through that same exercise you have, where I said, well, let's just step back. Let's look at the biggest picture we can. So what were we dealing with in 2022? Okay, we're dealing with really high running and increasing inflation, right? That was a concern. And we were dealing with a Fed that was seeing that and being very aggressive with monetary policy. Okay, where do we sit today? Well, inflation is improving. That's clear as well. And we're with a Fed that, yeah, okay, they've raised by 0.25% at the last few meetings, but again, getting very near this end of this rate hike cycle. So, I mean, just from those kind of simple, big picture ways, I mean, a better backdrop today than where we were a year ago when we really were at the beginning phases of this very aggressive rate hiking cycle with inflation that was kind of hitting those highs during last summer. So it's an interesting exercise the way you kind of talk through that, Mark, because I will sometimes just step back and say, well, gosh, these big picture things look like they're getting better. Let's hope that creates a better backdrop for the market as we move forward too.
So anyways, while we're waiting for a few more questions, waiting for questions to pop in, hit on this last slide where I think you're headed with it anyways.
This is my last one, but Mark, what I was good, and this was a little bit related to the bank stuff in that, let's see, how did the market take it? How did the market react? So
sure.
We saw at the beginning part of March when this started to come out, Silicon Valley Bank, those concerns, we saw the market get hit. It was down about 2.5%. But this, again, we ran this through the early part of April, continued to show recovery. I mean, the market pretty quickly got beyond that concern. And again, I think it's important to kind of see how does the market react to stuff. Again, something we're keeping an eye on, but the market really did recover quickly from that kind of initial, I don't know, we're really not saying banking crisis, but the issues we saw in some of those regional banks just kind of hit in March. So with that, yeah, Mark, you did a really good job of summarizing it. That's where I've kind of said, I think we are cautiously optimistic. We see, and again, we know the economy, or we don't know. We expect that the economy will likely slow as we move through later in the year. Again, that's our expectation. But in the context of still a really strong job market is what the basis, is what the core of the economy looks like right now. So, even if we do get some slower economic conditions, if that consumer and that job market can hold in there, and again, it'll likely weaken up as well. Again, that wouldn't be unexpected, but we think that kind of steers us more into that soft landing or mild recession scenario. Monetary policy, we think, get near the end of this rate hike cycle. Valuations, we are saying in that fair area, kind of in that middle part. Again, as an active manager, we're comfortable with a fairly valued market. Mark commented on it earlier. Most of the last couple of years, that reading has been in negative territory for us because we have been in generally a more expensive stock market. Sentiment can kind of move around, but we are still dealing with this a bit of a wall of worry, right? We know the market, we talk about how the market climbs a wall of worry historically. I shouldn't say we know, but that's historically what you see. So it's those times where you got to lean into the wind sometimes where you get some opportunities. And right now with that bearish sentiment, that's what we're seeing in interest rates. We think those longer term rates are kind of trending lower. And oh, by the way, if we did get into a recession, that mild recession, that could push interest rates down even a little bit further. And we'd have to see how would the Fed react if we got into that scenario. But with that said, yeah, Mark, happy to answer any questions you have, or if any questions have come in, certainly happy to go through those now.
Maybe while I'm just stalling, if you will, for another couple minutes before we finish up, Pete, you mentioned inflation likely to continue trending down. I'm shocked that the probability of a soft landing, i.e. no recession, in y'all's view is 40-45% odds right now. Again, with the backdrop that you painted, it makes total sense. Because if consumer spending is 70% of our economy, and you and I keep collectively, I should say, we all have our jobs, and we can keep spending. However much more it costs us for eggs, that's the question.
Yeah, it's a great point, Mark. I'll tell you, but here, it's a good one. Let me get specific here, because what's interesting is last year, again, we talked about how the market really seemed to price in a much worse earnings environment that we had. It also felt like the market priced in many ways, a recession or a really weak economic backdrop, and we didn't really have it. We actually had a pretty good rebound in economic activity in the third and fourth quarter last year. I think it was 3.2% GDP and then 2.6% in the fourth quarter. And yes, that was coming off of two negative quarters in Q1 and Q2. So certainly a slow start to the year last year, but a better economic backdrop. But what are we seeing now, Mark? Well, we do have the inverted yield curve, and that historically has been a sign that we see weaker economic conditions as we move forward. We've had an inverted yield curve prior to every recession that we've had since, I think it's like the mid-late 1960s. Now, we've had an inverted yield curve without having a recession, but not the other way around. We haven't had a recession without that inversion happening before. We have an inverted yield curve. Leading economic indicators, they've been kind of rolling over and moving downward for, gosh, I think probably about a year at this point, pretty close to that 12-month read. So that's historically a signal we see prior to that weaker economic environment. So it's a great point, Mark, where we're actually seeing indicators that historically have told us there might be weaker economic conditions down the line. That's why we want to acknowledge those. Now, when we're saying we see those clouds, we don't know if those clouds are just going to kind of pass over, if we're going to get kind of a light rain from those clouds. And again, or do we get a thunderstorm? We don't think the thunderstorm is the likely possibility, but we think it's probably one of those first two that, hey, the economy can engineer that soft landing driven by consumer strength. I agree with you. I think that would have to be the key driver. Or, hey, we do slip into a recession, but with the job market, even if the job market, we go from 3.4 to 4.5 or 5% unemployment, I mean, that's a very different scenario than 6 or 7 or 8% unemployment, right? So those are the parameters we're going to have to look at. I mean, so we keep an eye on this. Obviously, we try to look at what we think are higher probability or lower probability events, but it's a great point, Mark. We didn't really see the signs for a recession that we looked for last year when it felt like the market in many ways priced one in. We are seeing signs now that can tell us there might be weaker economic conditions as we move forward, but we think a lot of that might have been priced in last year already. So I would say even if we see one of those first two scenarios, the soft landing or that mild recession, we do think, that the market probably could do okay in either of those environments, right? We think those October lows, again, we don't know for sure, but we hope those would hold even in those two scenarios. And that's really kind of what we're looking at and analyzing right now.
Absolutely. Well, just a quick excerpt on the inverted yield curve. I know, Pete, you and I know what that is, but for our clients that maybe they don't hear this every day, the inverted yield curve is whenever your 3-month or your shorter maturity bonds, right? So 3-month, 2-year, et cetera, those interest rates that are being paid out on those are higher than your bonds that are maturing in 10 or 20 or 30 years. And so that's the definition of an inverted yield curve, is when those shorter parts of the curve, as it's called, are higher than the 10, 20, 30-year bonds. So anyways, Pete, as always, thank you very much.
Yeah.
You're always awesome. And I could sit here and just probably listen to you talk about the markets all day long, candidly, because again, I'm a nerd like that, but greatly appreciate it. I think we're supposed to have you guys back later this year, maybe. I think. I don't recall specific.
I think I saw some back and forth, but yeah, happy to join you all later in the year as well. And, look forward to that too, Mark.
So, but until next time, we'll continue to monitor things. But I always joke, Pete, with clients, I'm like, it's like you guys talk and the market seems to listen to you guys and it doesn't. I don't know. It just means you're that good at your job, I guess.
I don't know if I can claim that, but we keep an eye on it. I mean, this is something like you. We like it. We like looking at it. And, again, we're always trying to figure out where do we think things are going. And we really look at the data. I mean, we try to really say, okay, what is the data telling us? And let's really use that to try to kind of guide where we want to go.
Well, absolutely. The data is the best point to look at because the news media is not worth a darn. We'll leave it at that.
All right, Mark.
All right, Pete. Well, thanks again, everybody, for joining us. We'll queue up Dave Brubeck to send everybody on their way. And Pete, I'm sure we'll talk soon.
Thanks, Mark. Thanks, everybody.